The mistake that many stock market investors make is, one, they sort of hold off forever waiting for a dip in order to buy. And often the market will go up and up and up, and they're still waiting for a dip. When they wait for the dip, then when the dip occurs, there's always bad news, right? Because why does the market fall? It falls because there's bad news. And when people see bad news, they think, oh, I don't want to invest now. There's bad news. If you look at the returns of actual investors, you'll find that most investors horribly underperform the market. So you'll see the market does very well. Most investors don't do well. And the reason they don't do well is they always add money when things are going well, and they always pull money out when they do badly. And people think that you need to read like a Wall Street report. Well, actually, the guy running a sandwich shop might have more up-to-date, might be higher frequency data than you get from looking at earnings report.
Hi again. Thanks again for tuning into our channel today. So remember, part one, we have Mr. Patrick Boyle, who was a portfolio manager at RBS, Millennium, and Nomura. He also started his own company, asset management company named Palomar Capital, which he sold a couple of years ago, which is very successful. Part one of our interview, we got to know a little bit about Patrick and how he suggests our subscribers to get into the asset management field. So this time around, we're going to ask a little bit about what his view on the market is and a little bit about what he thinks is going to happen in the market in the year 2022. So thanks again, Patrick, for doing this with us.
Thank you. It's great to be here.
Okay, great. All right, so let's get into it. So majority of our subscribers believe that investment is actually a great way to get out of this so-called rat race, especially in very expensive cities such as Hong Kong or New York. So can you give us some advice regarding how to achieve this so-called financial freedom with investment tools such as stocks, futures, etc.?
Initially, I think for most investors, probably the easiest and the best way to make money in the stock market is just to invest in a diversified basket of stocks, and over time they go up. And that tends to be what happens. That's a very boring answer from a guy who does all this sort of short-term trading. But the truth is that most of the time, the stock market tends to go up. When you invest in the stock market, you're investing in a basket of companies. They're businesses that are basically, generally buying in some sort of raw material, processing it and selling it at a markup. And so for most people, if you put your money in a diversified basket of stocks, over the long run, by the time you're retired, they'll have grown at about 7% a year. The mistake that many stock market investors make is, one, they sort of hold off forever waiting for a dip in order to buy. And often the market will go up and up and up, and they're still waiting for a dip. So in truth, usually it makes sense to add your money in a fairly steady manner. Because the other mistake people make is when they wait for the dip, then when the dip occurs, there's always bad news, right? Because why does the market fall? It falls because there's bad news. And when people see bad news, they think, oh, I don't want to invest now. There's bad news, But if you invested in after the 1987 crash, when there was bad news, you would have done well. If you invested when Lehman Brothers went bust and the world looked like it was ending, you would have done well. And so often the truth is that you do well putting money into the stock market at the time when almost everything about yourself is saying, do not do this, it's a bad idea. And equally, you'll often find that at the times that it's easiest to invest in the market, when you look at it and you see, everything looks great, the market's going up and up, there's nothing but good news, often that's sort of near the top. I remember actually, because I started, working in markets in the late 90s, and I remember, there's the whole dot-com boom. And everything looked great. There was this brave new world, all these great companies doing new things. They didn't necessarily do that well. I remember, I guess around this time in 2001, everything looked great in the stock market. Business was booming and so on. And then a couple of planes hit the World Trade Center and, everything fell apart. And so it's very difficult to take a general view and say when things look like they're doing well, they continue doing well. And when things look like they're doing horribly, they continue to do horribly. Often, the market backs and forths, and you have to sort of have the strength to either put your money in when things don't look that good, or at least to stay in when things don't look that good. And if you look at the returns of actual investors, you'll find that most investors horribly underperform the market. So you'll see the market does very well. Most investors don't do well, and the reason they don't do well is they always add money when things are going well, and they always pull money out when they do badly. And there's some great studies on this. There's a great book, one of my favorite books on investing, by Jack Schwager. The book is called Market Sense and Nonsense. And Jack is, I don't know, he spent like 40 or more years in the markets, and he's analyzed all sorts of data and looked at the performance of the best traders in the world. And he's found that this is a general problem for investors, is that they always step in after things have gone well. They always get frightened and pull their money out when things go badly, and then they sit on the sidelines until things are doing well again, until they invest. And so for most investors, a very boring answer is that you probably need to start investing in the stock. It's reasonable to take more risk when you're young, because if you lose money when you're young, you have your whole life to make it back. If you lose money when you're sort of 65 years old and getting ready to retire, it's a lot worse, because you now have to work a few more years to make back your money. I really advocate people getting involved in markets, people putting their money in, because, in the United States, people do tend to put money in the stock market. I look in places like Europe and you'll meet people and they never ever buy any stocks or bonds or anything. They keep their money at the bank. And the problem with, especially right now when we're in a market where inflation is way beyond the return that you'll earn on your money. You put your money in the bank, but no, you think you're making 0.5% a year and you're really losing.
So let's get to the next question then. As an experienced fund manager and portfolio manager, what advice could you give our subscribers in terms of starting off with a small investment? So let's just say a $10,000 US portfolio. What do you think would be a good allocation for a small portfolio?
Well, if you're young and you have a small portfolio and you are interested in markets, I would say that with $10,000, usually they tell people that they should buy kind of 20 stocks in order to be diversified. That is pretty, 18 stocks or so, 18 to 20 is a good idea. And, a young person probably should invest in stocks rather than bonds or, many of the other sort of lower returning assets. They should probably, just for fun and interest, sit down and work out like what companies they like, why they like them, and come up with an investment plan where they're able to put, years ago it was difficult because of commissions and so on to diversify to 20 stocks, but nowadays, the cost of trading and investing, it's so much cheaper. It's actually quite reasonable to sort of find 20 good companies that you like and to invest. And I would also say that everyone, a really good habit to get into is to keep a notepad or a book or a spreadsheet or whatever it might be, and write down why you invested in each of these companies, and then write down why you would take money out. Like if it goes really well, do you have an exit plan? If it goes badly, do you have an exit plan? And write that down and stick to it, because often the problem, one of my favorite quotes, it's Mike Tyson, the famous boxer, he has this great line where he says about planning, he says everyone has a plan until they get a punch in the mouth, and you learn that pretty quickly in markets, where you'll see someone who sort of buys a stock and says it's the best company in the world, it's going to do well, I'm going to stick with this for 20 years. And you meet them a week later and they go, I got out of that, it moved down 2% on me and I couldn't handle it. And the truth is, if you have risk management rules or, requirements or whatever it might be, write them down and plan to do that. And really just stick with your plan, because you're much better at coming up with a sensible plan before you're sort of in the fight getting punched in the face, So that's a really, I think, a useful piece of advice, is because when you're making things up as you go along, you're basically trading on your emotions. And I would often argue that your emotions signal you almost to do everything wrong rather than what you really should be doing.
Completely agree. With the blue chips, Google, Apple, you're supposed to be making money, right? But a lot of times people are still losing money with these big blue chip stock because they get out when it goes down a little bit and then they're too scared to go back in. But in the beginning, I asked them, like, why did you buy this company? They said, oh, it's a good company. It's one of the biggest in the world. So I was like, why did you get out when it went down 2%. And then it's the same answer over and over again. They're scared, the roller coaster ride. So
yeah, and it's one thing, like if something has changed about the company, like we'll say if you got into a company and you said, well, the reason I'm investing in this is that they have no competition, they're a well-organized company, you know, a list of good reasons. And then a week later you work out that actually they're in a very competitive business and that the CEO is, you know, doing 5 things rather than the one thing he's meant to be doing. You know, you might change your position based on that new information. But if you're just going to change your plan because the market moved, you know, stocks move around, like they're volatile, and you know, a move of 1 to 5% on a day for many stocks, it's not a move. Like there's no news, you know, it just often the reason the stock goes down today is just that it went up a bit too much last week. And if you have a long-term plan with it, plan and just stick with it.
Exactly. So it's more important to look at the earnings that comes out every quarter rather than the stock price movement that comes out every day, because that's something you can't control. But you can control what type of stocks you buy based on their financials. So
even there's some old books, like there's I forget the name of it, might be One Up on Wall Street or something like that, Peter Lynch book, you know.
Peter Lynch.
And he talks about investing in the companies that either he does business with or his family does, you know, and it kind of almost the idea that if you find yourself always shopping at a certain store, or if you find yourself always you know, buying a certain product and it's clearly better than the competition, well then maybe it's a good investment, you know. And you can go out and I actually, years ago, I had a friend who was a very good investor, and every time I was in a store with him, like we'd go into a sandwich store and he'd ask the sandwich shop owner, how's business, what's going on, are there more people, are there less people, because these guys, you can get real information from a business person as to what the business environment looks like. And people think that you need to read like a Wall Street report. Well, actually, you know, the guy running a sandwich shop might have more up-to-date, might be higher frequency data than you get from looking at earnings reports. You know, like this guy knows if everyone has suddenly cut back their spending, or, you know, if people aren't coming into the city anymore, or whatever it might be.
Definitely interesting. So before I buy the Starbucks stocks, let's get into Starbucks coffee shop barista a little bit. Okay, so last question I think a lot of us wants to know is, what's your take on the current market situation, especially with COVID still happening all around the world, tapering about to happen in the end of the year, and next year we're looking at possibly interest hike, and right now with China and the potential default risk with all the big companies right now, the China Evergrande, and them laying the big smackdown basically on the tech companies, education companies, all these things happening right now. What's your view with the market conditions for the year 2022?
You know, the markets are very mixed at the moment. Like you know, sometimes a week ago I was talking to a friend and he said, oh, it's awful. And I said, what are you talking about? It's up like 18% on the year. I don't know, it's probably 17% time of our conversation. You know, markets aren't doing that badly. Sort of things to worry about, and we can look at them. You know, as you mentioned, the Evergrande thing is probably one of the bigger clouds on the horizon. I've made probably about 5 videos on my YouTube channel talking about Evergrande because it's a really interesting situation. You know, Evergrande is almost something to be monitored for useful market information. Obviously, the Chinese real estate sector doesn't look amazing at the moment, but what might be of interest is even just to see how the Chinese government deals with this. Because, you know, we look at China over the last 20 years and there have been all sorts of road bumps and problems, and China has just sort of stormed through them. You know, everything's gone well. But there is an argument that China today is different than it was all those years ago, because there's simply different people in power and they're making different decisions. And so in a way, what's so interesting about Evergrande, like, you don't need to look at it and sort of say good or bad things are happening. Evergrande will give you a hint as to how sort of people in running the Chinese economy essentially think about these things, like how are they going to deal with a big default. The Chinese government is going to be very concerned about this. They don't want a too big to fail situation. They've looked at this and they've seen that, you know, essentially some of these big real estate companies in China had the feeling, could almost be thought of as an extension of the government, and they would definitely be bailed out. And now it's being signaled that that is not the case, you know, that the government is not there to bail them out, that they have to run their businesses in a prudent manner. But then we have to look at this and sort of see, well, what companies can do well, what companies will do badly in this situation. And I think people who invest in China up until recently have looked at all of these companies and they've sort of assessed the risk of the stocks with almost how well connected the sort of senior management in the company are to the powers in Beijing. While now people have to reassess these stocks and they have to look at all of the companies and say, it's not about that. It's about cash flows now, and which companies can thrive and which won't. That's a whole change. And so big things will happen in China. But right now, I think the real thing to do is just to monitor the behavior of the Chinese government and the Chinese businesses and sort of try and work out, which way the wind is blowing, and then set yourself up so that you'll benefit from that directionality.
Great. Thanks for your insight. I think our subscribers learn a lot from both your interviews. And thanks again for your time today, Patrick. We hope to hear from you soon. And we'll definitely be monitoring the whole China and China Evergrande situation. Best of luck in next year. Thank you again.
Thank you.
2021年咧，終於嚟到尾聲啦！希望大家呢年咧過得充實啦，亦都咧及早為自己未來打算噃。join咗我網上10年財務自由課程朋友咧，就知道財資嘅重要性啦。加入咗課程朋友咧，你應該都加入咗師傅 Lifetime Coaching 噶啦。1月份 topic 咧就會講10年財務自由咧，失敗嘅原因係乜嘢咧？唔係因為揾唔到有回報嘅項目噃。新朋友首先咧可以去咗10年財務自由1小時免費簡介工作坊先，參加咗課程之後就自動加入咧師傅 Lifetime Coaching 嘅私人群組啊！呢個私人群組嘅開放咧係限時噶，每個月咧我哋都會討論下唔同財務自由嘅秘技噶。私人群組入邊仲會分享財智功課啊、消息啊、每月淺談等等，喺啲上完堂之後咧俾足你永久 support 添，千祈唔好錯過啦！未聽過呢個財務自由系統呢，記住咧去下面免費1小時簡介工作坊了解下詳情啦。咁我哋升級版呢，亦都有個強勁嘅優惠啊！3點鐘同埋9點鐘嘅升版，如果一齊報嘅話呢，我哋就回到加價之前，果然係超級通俗啊！並且呢，我哋喺2022年呢加入咗新嘅功能啊，譬如呢係會鎖定 commit 呢去講呢個獨家資金流啦，同埋3點9點呢，亦都會睇翻藍籌領升領跌股票，加埋 CFD 嘅短炒策略俾大家短炒過下手癮嘅。如果而家報2個升級版，總共係4-5折，1988蚊，報足12個月，再送多1個月啦！咁即係咧，每一日為翻可能3個幾港幣咋。下面快啲報名啦！留意報咗名之後咧，係唔會 replace 你而家有嘅會籍，係會 extend 嘅，延長落去嘅。所以咧，大家可以隨時報名。
Jackie Sir 加股壇劉元德嘅0至千萬加速器入邊會學到佢哋嘅秘技啊，包括 REIT 啦、短炒、美股組合、CFD 等等㗎。參加咗課程就會自動加入 Lifetime Coaching 嘅私人群組。1月份嘅主題係如何運用 ETF 做對沖，跌市時都可以鎖定盈利啊！有興趣嘅話，快啲掃下個 QR code， 免費睇下佢哋嘅簡介加工作坊同埋報名啦！ Interactive Brokers 係師傅用咗10年以上嘅交易平台。入到 IB 嘅網頁，只要撳翻右上角嘅免費試用，登記翻一啲簡單嘅資料呢，就可以免費使用平台交易啦。富翁團隊又請人啊！今次係請香港嘅同事啊！我哋請緊社交媒體編輯、content writer 同埋 research analyst。如果有興趣加入，又符合我哋列出嘅要求嘅話呢，就記得 send CV 俾我哋啦。想每日緊貼大市，即刻下載我要做富翁嘅應用程式。我哋每日收市前都會同大家詳盡分析㗎，約定你啦！
想緊貼我哋，記得訂閱我要做富翁嘅 YouTube、Instagram 同埋 Facebook。如果想更加緊貼大市同直播分析嘅話，可以訂閱富翁電視 MTTV 啦。另外，想跟我哋環球睇樓，記得去訂閱我要做世界頻道啦。